Good morning, everyone. So it's Saturday morning, March 18th, 2023. Just wanted to give everyone the weekend update. So these are our closed out class trades that we've made since December 1st. This is the bar chart that shows those different P&Ls. So this shows a trade by trade P&L. Of course, I'm using Option Trader's Assistant here that I track all of my trades in. This is the equity curve of those trades. So obviously looking good there. We did have, of course, a couple of minor misses along the way, but that's you're going to have that in trading, so we can't get concerned about that. Overall, things are going as we want them to. Now let's take a look at our open trades we have at this point. And so we'll load up our graphs here. So these are the 4 open class trades. So we've got this one open in SPX, and it's doing its thing. It's in a nice range, nice flat T0 line. Nothing we really need to do with that. It's about 4 weeks from expiration. So we'll wait for our markets to kind of chop back and forth in this range and then decay in there. And I guess we should take a look at our chart first here too, though. So this is the SPX. As you can see, we've been in an extended downtrend. We did break through our downtrend, came back, bounced off our downtrend line, came back, went through our downtrend line a little ways, but fell right down to this support level, which was kind of a little bit of an expected area. We have since bounced off of that as I had anticipated we would. And I was thinking we might come back into this 4,000 range or so, which could still happen here in the next week. We could even get all the way up here into 40.50. But overall, I'm expecting us to probably be ranging between 40.50 and 38.50 over the next week or two. Again, barring any unexpected, unplanned news. Um, we can see now I did put in this uptrend bar, but that quickly got broken here. Had we pulled back into that range and then taken off from there, we may have had a trend reversal. I'm not so sure we've had a trend reversal yet at this point. So we also had some very high volume. We can see this volume bar here. So when we did have our down day, that was on some significantly higher volume. Which can tend to give an indication of a direction as well. The direction here being a little more bearish at that point. So anyhow, that's kind of where we're at with SPX. So again, we're expecting 38.50 to 40.50. So let's just come back and take a look here. So if we get up into the 40.50, yeah, we might need to adjust that. 38.50, perfectly fine for this trade. Shouldn't present any challenges to it. So this trade is setting up well, or is working along well. This one, we have the SPX with the actually 2 long calls in it now. Remember, we did have a butterfly and a long call. We pulled off the butterfly for a profit, and then we went and added a new butterfly. And when we did, we also added a new long call. So this one's got just about 3 weeks, 3.5 weeks left on it. We should get some nice decay in this tent. Likewise, we can come down here to 38.50 is kind of right in the center of this tent, so that's perfectly fine. If we get a market rip up and it happens soon, within the next week or so, those long calls will kick in and give us some nice profit in this trade. The area we have to be somewhat concerned about is if we just chop back and forth here over the next week or two, these long calls are going to decay further. Our T0 line is going to dip here, and we may need to take that into account if that starts to happen. So this is our RUT trade. So let's just take a quick look at the chart on RUT, and we'll do the same analysis. So in RUT, of course, we had this huge pullback. Again, RUT is composed of a lot of banks, financial institutions, etc. So a pullback like this, when we had that banking news, this is a good higher volatility time that we might want to consider entering, which we did, that broken wing butterfly trade. It has pulled back to an area of support, but it's hammered on this support area now 1 time, 2 times, 3 times. So it is weakening our support here most likely. So it wouldn't surprise me if we did drop through here, maybe even came down into the 1675 range or so. So here we're looking at a wider range. We're looking at maybe a low of 1675 under normal circumstances, probably high of about 1850, 1875. So let's just take a look here. If we come back into the 1675 range, that's going to be fine. It's going to bring us down a little bit, but we're still nicely in the tent. So that's perfectly fine. If we get up to that 1875, that's not going to have much impact on us at this point. At some point, we might need to do a little adjusting of that upper wing if that occurs. But if we just chop back and forth in here for a while and theta decay kicks in on that, that will work perfectly fine for us as well. So let's look at our FedEx earnings calendar trade. So this one, kind of an interesting, trade. This had been, as you'll recall, this had been a calendar trade, but our front period, our short period that we sold, expired, leaving us with this. So this is what we want. Well, it's not what we wanted. But when we have that longer out expiration, in this case, all the way out April 21st, 34 days, one of the reasons I do these and the way that I do them is we captured full profit on those two short strikes that we sold. We sold those for about $4.25, as I recall. So we picked up $800 in profit there, but these dropped significantly in value as well. These had been trading about $8.50. So while these lost $6, our front month only lost $4, leaving us the roughly $200 that we're currently down in this trade. So what are we looking to have happen here? Well, let's take a look at a FedEx chart as well and see kind of how many times these big pops play out. So FedEx jumped up hugely, 225. Then it started trailing off. Now, this is fairly typical after a massive gap like this. Gaps like to fill. So you can see this gap here. Over time, that gap filled. After that gap filled, it started selling off again. So we're kind of expecting the same thing here. We had this huge gap up. The expectation might be that it's going to float back down here into this 214, 215 range to fill that gap. When it comes back down into this range, possibly sometime early next week, that will be the time that I would look at coming in and selling yet a different short strike here. Now, we could do this one of two ways. We could come in and we could sell a put on this at, let's say, 210, and we could sell that right here where our at the same date expiration that we're already at, okay, and again, this is out April 24th, that will turn this into a vertical, and then we could even take it one step further if we want, and we could turn this into a condor by selling a call spread as well. Now, exactly where this is going to be, we'll have to determine that. Actually, it'd be a butterfly since both short strikes are the same. But I would not do that. We would come up and widen this out a little bit. There we go. Do it more into a condor situation like this and let it decay within there. So that's one possibility. Another possibility here is that we could, and I need to come in here and make a different front month here. Let me clear this out. Is we can also continue to sell another expiration on this. So let's just turn this to, let's say, April 14th. And then this one can be our April 21. And so in this scenario, we could come in and you're not going to get much. Actually, you're getting a little more than I thought for selling that April 21. So let's just see what that looks like. So we can bring in that scenario, we can bring in about $400, which greatly reduces the overall risk in this trade. At that point, we're going to have, a maximum loss of around the 375 to 400 range. Remember, when we entered this trade, the maximum loss was as much as $800. Now, a different way of doing this is we do this instead of a calendar, we can do this as a diagonal. Maybe do something like this. Now, if we're doing this, we have to understand that we're taking on a fair amount of additional downside risk should this blow all the way through everything. But we basically would be able to get back to maybe a break even on this trade in that scenario. Or maybe we split the difference and we come in here somewhere like this. And then we could, after moving or adding this short strike in our April 14th expiration, when we get closer to the April 14th expiration, we could make the one last move then of moving this to here and turning it into a condor at that time. So again, the nice thing about the way that I do these particular earnings trades is if something goes hard against us, like it did here, we've got time to sell things against that further dated option to help reduce the loss. That's the premise behind the whole concept of this much further out long date in an earnings calendar. And we'll get into this much deeper in the in the calendars and diagonal class a little later this year. But that should give you a little bit of an insight into how these work. The one thing we don't have going for us here when we're selling these, initially when we sold these, we had high volatility because we were going into an earnings report, and it's great to have that additional higher volatility because, of course, this option that we're selling is going to be greatly inflated at that point. After earnings, we don't have quite that level of inflation in these options usually. So that is an edge that we've kind of lost at that point. But regardless, we can still pick up additional money by selling these shorts along the way until we finally get to this expiration date, and we'll close that trade out. So that's where we're at on the FedEx earnings calendar, and that kind of concludes our weekend update here at this point. So look forward to seeing everyone in the trade group next week. Take care.